my dad reaches out to me. He says, well, Chris, when are you going to sit down with me and become my financial advisor? And understand, he was like the penny pinching super saver. He would only buy things on sale, right? Like he bought Cap and Crunch, a whole case lot of Cap and Crunch that took me a year to get through. It was that bad, right? I have scars in the roof of my mouth still from that Cap and Crunch. I mean, the guy stuffed the money in his 401k, got the company match like every good boy should. He paid off all of his debt in 18 years, including his mortgage. This guy was 100% debt free. Yet despite all of that, I had to tell him, Dad, at 61, if you were to try to retire today, you better hope you die in about 5 or 6 years, because that's when you're going to run out of money.
Welcome back to the Thrive and Prosper podcast. I'm your host, Ari Page, and today we're talking with an absolute cash flow expert, the founder of Money Ripples himself, Chris Miles. To those unaware, he's the anti-financial advisor who's made a name for himself on how to create passive income and financial freedom without following the old school save forever mindset. So, get ready to learn how to keep more cash, build lasting wealth, and accelerate your path to financial freedom on this very call. Chris, thank you so much for joining us today.
Hey, I appreciate it, Ari. I was so excited to be on here today. It's going to be fun. I can already tell.
Yes. Awesome. So to start with, why don't we go ahead and bring everyone up to speed on your background and how you got into the world of infinite banking and financial education?
Yeah, not the way I intended. I actually wanted to become a business consultant. You know, I wanted to be like the Bobs from Office Space.
What would you say you do here?
You know, that's what I wanted to do for my profession. Rather than just getting an MBA, I needed real life business experience. So I actually took a sabbatical from college. I said, all right, let's just see what's out there. What kind of business can I start? And the first one that was kind of intriguing was becoming a financial advisor. Not knowing they take anybody off the street as long as you can pass a test with 70% and not, rob banks. And then you qualify. And so I did that for several years, loved being my own boss. I actually dropped out of college and never finished to get my MBA or anything. And so I was on that path. About 4 years in, my dad reaches out to me. He says, well, Chris, when are you going to sit down with me and become my financial advisor? Now, I went to sit down with him, right? And went back to Oregon where I grew up. As I'm sitting at his table, I'm looking at all his finances for the first time in my life. And understand, he was like the penny pinching super saver. I mean, this guy saved everything, spent nothing. I mean, he would only buy things on sale, right? Like I remember buying, he bought Cap and Crunch, a whole case lot of Cap and Crunch that took me a year to get through. It was that bad, right? I have scars in the roof of my mouth still from that Cap and Crunch.
You and Captain make it happen.
Anyways, I'm seeing his finances, and I could tell he was diligent. I mean, the guy stuffed the money in his 401k, got the company match like every good boy should. He paid off all of his debt in 18 years, including his mortgage. This guy was 100% debt free. Yet despite all of that, I had to tell him, Dad, at 61, if you were to try to retire today, you better hope you die in about 5 or 6 years, because that's when you're going to run out of money. I said, all right, well, that's not what I wanted to hear from you. Like, give me the answer. What do I need to do to get out of this job? It's literally killing me. I've already had heart attacks and strokes. I said, I don't know. You've done everything right from what I teach as a financial advisor. And I walked away pretty upset because I told him, well, you can save more money, save longer, keep working until you're 70, like that kind of stuff, which is definitely not the answer I wanted to give, because I always teach people that, hey, if you just save $100 a month for the next 40 years, making 12% a year, you'll be able to retire a millionaire, right? All that kind of crap that you've always been taught by Dave Ramsey and all these other quacks out there, right? And I was the one teaching it too, and it wasn't working. I saw the evidence. My dad saved better than that, and it still didn't work. And so about a month later, I'm talking with a friend of mine that I actually hired to be a financial advisor, but then he quit to go do real estate investing. And as we're talking, he just asked me, he's like, well, Chris, how many of your clients are financially free where they don't worry about money? I said, well, you had to throw that last part on there. They all worry about money. Even the ones that are retired still worry about running out of money too soon. Okay, great. So none. Got it. How about this? How about you guys? How many of you as financial advisors are financially free, not off the commissions, but actually doing these investments? Because you guys should have this figured out, right? And as I started to think about it, I was like, man, there's guys in my office been here since the 1970s, since pretty much before I was born. I can't find anybody who had been able to retire. He's like, well, there's your problem. So I was like, all right, I'm open. And so he had me go read this book by Robert Kiyosaki called Who Took My Money. It's a lesser known rich dad book. Then he also had me listen to this AM talk radio show, because this was 2005, 2006. This is pre-podcast era, right? And I'm listening to this AM talk radio show locally here in Utah. And pretty soon, as I'm hearing these real estate investors talk about stuff, I realize after a few months, I can't keep teaching what I'm teaching. I got to get out of it because I can see it doesn't work. And why would I teach something that doesn't work just because it pays me? That to me is just, your integrity never aligns. And so I quit. I said, I'll never teach about money again. I'll never do any more education on finances. I'll just be a mortgage broker. I'll maybe do a little bit of stock trading, and I'll be a ballroom dance instructor, which is pretty much what I had done. And, but of course, I wanted to know how I met all these real estate investors in their 20s and 30s that are like millionaires or multimillionaires. I want to know what they knew. And so I started to learn not about accumulating money, like I taught as a financial advisor, but how to accelerate it and live on passive income. And later that next year in 2006, when I was 28, almost 29 years old, I had enough passive income coming in that I didn't have to work anymore. I literally was work optional. I could work because I want to, not because I had to. And that blew my world up. It just blew it apart because I was hoping and praying I would slave and save away, for like 20 years. And then hopefully by my 40s, I'd be able to retire. And here I am, 28 years old, I'm able to retire. So naturally, people want to know how I did it. So in 2007, I came out of retirement to teach people how I did it. Started a company with some partners. Of course, it was right at the recession as it started. Horrible time to start a company, especially when your target market are real estate investors. So our company's going broke. I'm going broke because my real estate's starting to go down. So I went from millionaire to upside down millionaire. Had to find a way to dig out of that hole. I had basically bootstrap it because my credit was shot to like a 480, and so I was like pretty much flat broke. Didn't go bankrupt, but it would have been better if I did, if I wanted my credit score to be higher. So I eventually dug out of that hole slowly. We were able to pull that company out of almost bankruptcy by 2009. And then finally I started to build my life back up, started Money Ripples in 2012. And then actually the end of 2016, December 2016, I was able to be financially independent for the second time when I was 39 years old. So when people say, how'd you retire twice? Easy. I screwed up the first time, then had to do it again. And that's what I've been teaching people to do is how not to screw up the first time and how to actually do it in a way that's been proven, not just for me, but for other people too.
And the way that you helped your father, is that what then became the blueprint for Money Ripples?
No, it was actually how I helped myself. How I did. I was my own laboratory. Unfortunately, my father ended up working into his 70s, just like I had said. And now he's 81 years old, and he's literally trying to stretch out every dollar he can from his investments that every financial advisor said he should have more than enough, right? He's stretching every dollar because now he's got to pay for healthcare and home healthcare and things like that, I mean, all these things that was supposed to be the ideal dream. The guy that was a poster child for Dave Ramsey is literally living in scarcity, right? And so, no, it was actually for myself first. I was my own laboratory first, and then I started helping others do the same.
Unless we're generating more than the basic inflation rate, and a lot of people aren't even thinking about that how inflation is built in at a 2% rate per year over year. In 50 years, you're talking 100%. Literally.
And that's BS. That we know it's way more than 2%, but that's what the government
exactly
does to lie to us, so they don't have to raise Social Security as much and don't go broke as fast.
Right. So that type of investing strategy will never get you anywhere, not unless you have to do something much bigger, which is, of course, why I have you on here today. So tell us more about Money Ripples. Yeah.
So really, that's what we do. We work one-on-one with people to strategically figure out how do you become work optional. So rather than a financial advisor who says, here, show me what money you've got. Cool. I'm going to throw it in the stock market because that's the only place to put it for a financial advisor, right? It's always in, the S&P or in mutual funds or something like that. We look more at the alternative investment side. We're looking at investing in Main Street investing, not Wall Street. So for example, like if people want to do lending, right? If they want to do lending where they lend to investors and things like that, making 10, 12+% a year, they can do that. And so we actually connect them with people that have been proven, have proven track records, been doing it for years. Essentially my own database of investors that I've built up over the years is what I share with our clients too, if they want to use them. So it could be apartment, syndications, right? Investing in apartments where you pool your money with other investors, self-storage. It could be things in like car wash businesses. It could be oil and gas investments. It could be raw land and things you can do there. You can create cash flow. I have a raw land business partnership right now that I'm hands-off investor, just financing it. That's it. But I'm literally like just over $500,000 is generating almost $13,000 a month just from that alone, So things like that, like even it could be rentals, but turnkey rentals where you're hands off, you're not the property manager getting in it and stuff. So many different methods that we open up people's world to. It's like the freaking Matrix red pill, right? It's like, here, take this red pill. You realize there's this whole other world you didn't even know existed because your financial advisor does not make money telling you about it. It's either one, they don't know about it, or two, they don't get paid, or they legally cannot advise you to do that stuff. So that's where I become the anti-financial advisor. We're going outside of Wall Street saying, here's the stuff you can actually be doing that can generate real passive income right now, not waiting 30 or 40 years to see if it actually worked out for you, which, and unfortunately, in about 98% of the cases, it doesn't.
And how does Money Ripples work? Do you get assigned a financial advisor when you get started?
Yeah, so we're not investment advisors. We don't ever claim to be, but yeah, we do act kind of like a fiduciary that way, right? Where you do work with somebody one-on-one. So we're having like these one-on-one sessions, figuring out like what's your strategic game plan, right? So we kind of go through a 5-step process when we do it. Like we're really looking for where's the low-hanging fruit. And it's not just about passive income even, but also like where can we improve your cash flow in your situation? So for example, if we're analyzing your cash flow, looking at income and expenses, not just like how to cut out the latte kind of crap, right?
Yeah.
Not like that, but even just like, hey, can we free up money on taxes? Can we help restructure your debt and do some things in ways that can actually increase cash flow that way? Can we
the bigger move.
start tracking your money and doing stuff, right? And I mean, it's crazy because even before I started doing the passive income side of things, because I never teach anything I don't do. So like when I was going broke, like around 2007, 8, 9 or whatever, I started teaching people how to free up cash flow because I wasn't doing anything with passive income. So I was like, I'm not going to teach people how to get out of the rat race, but how to find money, because that's what people were asking during the recession. And so we would find on average about $34,000, $35,000 a year. To give you an example, we had one client where they came to us, and this is more recent, right? They came to us wanting passive income. They had $5 million between like their tech stocks, like Google, Meta, things like that. They realized they weren't diversified at all. Like they were very high risk. So they say, yeah, we want to look at real estate investing. We said, great. Well, first things first, let's look at your cash flow. We looked at cash flow and said, wait a minute, we can do some things here. We can start altering some of the stuff in your situation without investing a dollar yet. So for example, I looked at their situation. I said, wait a minute, we could refinance your house. You could actually do a cash out refi even and actually pay off some of these other loans you have. Even though they made $500,000 a year, still there's different loans they had that they're like, yeah, whatever, we make, $40,000 a month, we're fine. But it's like, well, we can get more efficient with your debt structure here, pay it all off and consolidate it under your loan. We freed up $3,800 a month. That's like $45,000 a year right there.
Yeah.
And then I said, hey, you're a business owner. I guarantee you're overpaying in taxes because all business owners pretty much are. Let's have you talk to one of the CPAs in our network. And so they started talking to one CPAs, freed up over $30,000 a year, just that. So already we're over like $75,000 a year we freed up without investing a dollar. Then we saw they had an investment property, but that investment property wasn't cash flowing, but it had $200,000 of equity. So we said, hey, let's sell that property off, take the equity, invest it somewhere else. Now we can make about $2,000 a month. And so we pretty much increased our cash flow by about $100,000 a year before we even had to worry about cashing out the stocks they wanted to invest in the first place into real estate. And that's kind of the process we take people through is like, how do we really increase that cash flow situation to where, yes, maybe your expenses come down, maybe they don't, because we get a lot of super savers too that are dirt cheap anyways. But if we can get the expenses down here, but we get your passive income up over here, now you're financially independent. Now you are work optional, where you literally work because you want to, not because you have to. And so we just customize and tailor fit that plan for them. And then even as they start to increase their passive income, great, let's take that passive income and reinvest it. I call it like an income avalanche, right? You just keep doubling down, figure out which investments end up being the ones that you like the most as you start to try these out. And then of course you get to do that. So we don't take any money under management. We don't touch any of your money. We just help connect you to those deals if you want to be able to do that. Let's give you the education to empower you so you can actually really figure out like, what can I do even on my own? Even if I go outside of that network that we have.
So it sounds like a very holistic approach. You're looking at the entire individual's portfolio and you're figuring out what you can do to maximize cash flow before even looking at making huge money moves and investments. So I like that.
Yeah. Everything's about now in the present day, right? Kind of like my sign says back here is like, live your life now and not tomorrow. You don't know if we're going to be alive long enough to enjoy our retirement accounts that the financial advisor sets up for you. Like right now, if you can create cash flow right now, that's what makes the difference in your family's life, not hacking away in a crappy 401k and hoping and praying it's going to work out.
So we've heard a lot about the term infinite banking, but could you break that down and explain for everybody what is infinite banking? How does that tie in?
Yeah. So during that same time when I was realizing that as a financial advisor, I suck, right? And everybody else does too. I started meeting with these real estate investors and they started talking about this infinite banking concept. This Nelson Nash, he wrote a book called Becoming Your Own Banker. And so I had all these people tell me, oh, you got to get this whole life insurance policy. It's called infinite banking strategy that you use with it. And I had to say, I was like, wait a minute, whole life insurance? Like, I was a financial advisor. I taught people to never, ever get whole life insurance. Why would I get that piece of crap? Now, I didn't know anything about it other than what other financial advisors taught me. They just taught me, oh, you make it like 1 or 2% a year. So it's BS. Don't use it. Stock market is better, right? That's what I was teaching and what I've been taught. But I see all these guys are millionaires saying, no, this is awesome. You should do this. So anyways, long story short, I go find the guy that actually set them up. Granted, I had an insurance license, but I didn't know how to set up for myself. So I went to the guy that was the expert. And I remember looking at that policy. I thought, man, this thing's expensive. I mean, I read the book. I get it. Like, yeah, you're supposed to use it to like buy cars and houses and stuff, apparently. But man, like those first few years, like I got nothing to show for it. He's like, well, they're all like that. And so I said, all right, cool. I'll take your word for it. Well, that was 2006, 2008 rolls around. I can't afford anything because I'm in the whole like $15,000 a month between my business and my personal life. And so I end up calling up the insurance company. I'm like, hey, what can I do with this policy? Like I've been paying $1,000 a month for the last couple of years. I put in 25 grand. Can I stop paying for a bit? And they said, no, if you stop paying, the policy is lost. And so I lost it. 25 grand down the hole. And again, I was always taught, you just, it's okay because in 5 or 10 years, you use this thing like your own bank. And they call it infinite banking because they say, you can use that money to go like say buy a car, right? Rather than financing it, you go buy a car with that money and then you quote unquote pay yourself back interest, right? But what I found out is there was a bunch of little freaking lies that were coming out of this, right? That weren't true. And in fact, I even still to this day see guys on social media talking about infinite banking. There's all kinds of lies going around about that. You pay yourself back and all this kind of stuff. So let me teach you from my perspective what I learned, because I did find out later on that this insurance agent lied to me. Because when I asked him, could we make it better? He said, no. I found out you could. You can actually make this thing pay for itself quickly to the point where it becomes really like a tax-free high yield savings account. Because we all want like the high yield savings account to have liquid cash, right? But right now, even my nice, like really high returning, quote unquote, high yield savings account is paying about 3.6%, right? Nothing to get excited about. And then I get taxed on that 3.6%. My bank pays me 0.1% and I get taxed on that. So it's like 0.0% that I get taxed on, And with this, like with the whole life insurance, right now it's paying 6% a year tax-free. So even if you're just to use it as a place to hold your cash, right? See, everybody teaches you, all these insurance agents will teach you, it's like something to be putting away for decades from now because they have the death benefit, but it has this tax-free savings account part that they'll talk about you can use for retirement. But that being said, I realize if you structure it and design it the right way, you can use it from day one. Not have to wait to retirement. You can actually use that money to actually go and invest. So you not only can earn 6%, then you can even leverage it by borrowing from the insurance company. Yes, you pay them interest, not yourself, but you pay them interest. You're able to borrow at a low rate from them and then use that money to invest elsewhere. So one thing we always love, especially in the finance space, right, is we love leverage, right? I mean, I know what you guys do. I mean, you're always about the leverage as well. How do you get the best leverage and what you can do to create more acceleration of your money and get it to return you in your business, in your investments, whatever it might be. That's how you use this too. Granted, you're self-funding it. It's not like you're getting bank funding, but as you fund this money into this tax-free savings account, yes, you can withdraw the money. But when you withdraw money from a bank account or even from this account, now your money's no longer earning interest. You have to get it out to do something to make interest. But what if you could still have the money here earning tax-free compounding interest and get your money out investing at the same time, essentially making money in two places at once? That's what you can uniquely do with infinite banking, specifically if it's designed the right way where it's not super expensive and you're not losing all this money to insurance costs. And that's what I use it for. So like, for example, I show this example all the time. Like if someone wants to not, take down like a $1 million fourplex, right? Now I would have to put $250,000 down, but I love leveraging the bank, especially when I get cheap rates. Anything that's pretty much single digits, I like to leverage. Sometimes I'll even leverage double digits depending on how I invest it in my business, right? But I go and I get that mortgage for the 75%, but I got to put the 25% down, like $250,000. So I could just withdraw the money and dump it down. But again, I want my money to make money, because if I did that with savings account and just threw my money down, even if it paid me, say, $2,500 a month on this money that I've used I put a $250,000 down payment on, that $2,500 a month goes back in my savings account, slowly building back up while it pays me 0.nothing%. After I get taxed on it, after 9 years, if I made 0.1% on that money, 9 years later, even though I'm putting in $30,000 a year of payments into that account, I only made about $1,200 of interest. That's nothing, right? Especially for us that like leverage and like to create acceleration of our money. But I actually went and did the same numbers with my own life insurance. And I'm in my mid-40s. So understand that if you're younger, you might get better returns than me. If you're older, you might get a little bit less. But regardless, using my own money, right? Using my money from my life insurance instead. But now, instead of keeping my money in there, that's still growing, they're still paying me that 6% tax-free. But then I'm borrowing money from them. And then I use that money to use for my $250,000, because they're just using my money as collateral, right? That's all they're doing. They're saying, hey, you've got collateral in here, we'll give you a line of credit against it, just like a bank would. Now, when I use that money, of course, I'm going to take the cash flow and use the payback towards my line of credit with that insurance company. Here's the cool thing about the line of credit with the insurance company. You can pay it back however, whenever you want. The balloon payment, quote unquote, is your death. So there is no minimum monthly payment. So like, for example, if I use a credit card, I got to start making payments on it right away. Even if I haven't made the cash flow yet, even if I invest in my business, I'm not, it might take me several months before that business starts to kick off the ROI for my marketing strategies or whatever I'm doing. Well, here, yeah, they'll charge me interest, but they're not requiring any monthly payments. So it gives me that freedom that frees up my cash flow so I can focus on just getting the ROI and then use that money. Well, like I said, in that same example with that real estate property, right, where I use the cash flow to pay back towards that line of credit, it's paying the principal down. So as I'm doing that, I get charged less and less in interest. While they're compounding my interest, I get charged less and less. And the crazy thing is, even after the insurance costs and the interest costs and everything else, I net over $126,000. Not $1,200 like it would have if I used my savings account, but $126,000, 100 times more in that same 9-year period. That's the difference. And so for all of us that want leverage, right? We want to get our money working two places at once. That's a great strategy to use that you can really get awesome bang for your buck. And even beyond that, I mean, so many guys have been using this over the years, right? Give you an example. I mean, JCPenney during the Great Depression, he actually paid his payroll for his employees during that period of time using his life insurance, using the cash from his life insurance. Walt Disney actually funded Disneyland by selling off his vacation home. And then he leveraged his life insurance to have enough collateral. So then ABC came in, the network ABC came in to finance the rest of Disneyland. So we actually literally have the happiest place on earth because he used this infinite banking strategy. Even more recently, Jim Harbaugh, he was a coach for Michigan. He's now over at the San Diego Chargers as an NFL coach over there. He actually, when he was getting paid his employee, some of his employee compensation from the University of Michigan, he asked them to loan it to him for $4 million up front and then $2 million a year at 0% interest. And what were they contributing to? His life insurance policy. They were putting it in because he knew, hey, I'm going to 0% loan from them. I'm going to put it in here. He still had to leave the cash in there available as collateral in case he ever quit. They'd have to pay him back. But he knew he was making interest off their money, right? So he was literally like creating leverage off their money. And here's the cool thing. Because they were loaning him the money, guess how much he paid in taxes?
None. Yeah.
0, right? It paid nothing. So he was literally getting paid a few $1 million a year tax-free to then put that money into a tax-free place. It grows tax-free, comes out tax-free, creating all this leverage. And so there's so many people have been using it. Wealth have been using it for years, but sadly, most of the middle class and even the lower upper class have not really been leveraging this the same as what the wealth have been doing.
Chase Bank, for example, actually has more assets of this whole life insurance on their top executives than they do in all the real estate they own worldwide. So I found that quite interesting. It sucks that you had that initial experience with using whole life insurance. Because I've been using it for quite some time now, over 10 years. And I've found it extremely beneficial to be able to put money into an account, be able to loan out of that account, but yet not really loan out. Because if like there was some times where the insurance company that I'm using was making 20% on the money, and of course not every single year, but there were some years where it was 20%, some years where it was 18%, some it was only 9%. But either way, that's huge. A lot of people aren't making those types of returns on their own. but you're investing
Oh,
into
no.
your own
No, no.
whole life insurance policy and then being able to loan it out. Now, when they loan it out to you, they're loaning it out around 5%. So you're still, if they're making 15% and loaning it out at 5, this is what Chris is saying, that you're now making a 10% spread on your money from the insurance company, as well as it being loaned out to wherever you've invested it into real estate or whatever.
And remember, the insurance company is also paying you on top
Right.
of that. So even if you're making that, even if you made that 10% spread, you're like, oh, that's 15, but I only make 10 now. But yeah, but remember, they're paying you at least 5% or so in the account
Exactly.
too. So you're still making at least 15%.
Right. And worst case scenario, even if they have a year, which has not been the case for the company I'm with, but even if they have a year where they weren't making more, they weren't earning more on your money than they were loaning it out for, you still have access to this money to be able to loan out. And, and with the whole way that the beneficiary works in the end, you could pay it back. You don't even have to pay it back until you die if you want to. It's just an amazing, but I will say it's complicated because it's one of the few vehicles for investment that's outside of the banking industry. So you don't have to pay taxes on it. You're not paying taxes on it. People don't understand. First off, how can you make double interest? How can I have money loaned out into a real estate investment as well as still have it in my policy and make money? It doesn't even make any sense. It's like that thing where the quantum physicists tell us that this particle is in two places at the same time. We're like, how can that be? But it's true. It's like,
no different than
yeah, many people are using it. I use this policy. Chris has one. Like we were saying, all the Fortune 500 companies, they have this on their top executives. And I don't mean that they are just recommending that they buy it for themselves. I mean, they buy it for their executives and make themselves the beneficiary of it. That's how powerful this stuff is. So that's a part of Money Ripples.
Yeah, we actually brought it in-house in 2017. I used to refer it out, but here's the problem you're going to find with infinite banking is that they're not all created equal. Not just the insurance companies, but the agents and how they do it. Because I wanted an agent that actually would design it the way I wanted, not like what that guy did. By the way, that guy did admit to me when I debated him on it. I showed him numbers and how I would beat all of his numbers. He finally just said, Chris, I did it that way because I couldn't afford to cut my commissions. There's your honest truth there, finally. And I referred him family, friends, all kinds of people. And so we actually took it in-house. I was like, you know what, forget it, because I can get a better ROI than even the guys that I keep referring to. Because the problem is, if you get agents, they can adjust the amount of costs that are coming out of your policy to a certain point, right? So like, for example, when we do it, we are actually cutting our commissions by about 80%. You rarely ever find somebody even willing to go that far with it because they go into scarcity. They think, well, this is how I make my money. This is how I make my living. The thing is, we make millions of dollars still because we just do what's right and because it makes more sense. I had a real estate investor that he bought a crappy policy. He was only putting in, he's a multimillionaire putting in like $6,000 a year or so, right, into this policy. But then he told me after 6 years, he's like, Chris, I only have $18,000 in here. I've paid $37,000. This is not like what you were talking about. I'm like, duh, I told you the guy was a schmuck. Like, don't do that. And so I showed him how much better it could be. He's like, man, like if I can have like 80% of my cash from day one, and that's the most expensive year, and then by year 3, it's paying for itself. It's like, freak, I'm going to do $50,000 a year. And then even since then, he's done like $150,000, things like that per year, because he realized like I get all my cash back.
And when you get further in, your account actually goes up faster than the amount that you're putting in, and
much faster.
In the first few years,
most time,
not to the same extent, but then as you get further in,
yeah, like if you do a normal whole life policy, like the ones that Dave Ramsey rips on, which I agree with him, because those policies do suck, the traditional whole life, it might take you 15 to 17 years of you paying in before you finally have as much money as what you paid into it. So for example, if you're paying in $10,000 a year, it might take you 17 years to finally get up to that $170,000, and then it starts making more. With ours, 5 years, you have more than what you've paid in, because it starts paying for itself. Like the first 2 years always will have a net cost, but once you get to year 3, it starts paying for itself. It starts growing by more than what you're putting in. That's where it becomes more like that tax-free savings.
And often people are choosing the wrong accounts. They just don't have an advisor that has been there that said, listen, I had one of those and I've had one of these. Look at the difference.
It's fun because when you do that, especially if you're trying to be healthy from a bank perspective, especially if you want to get leverage your credit and be able to get more financing, things like that, this is like one of the few places that you can use to get loans. Like it's liquid assets, right? I don't even show people my bank statements anymore. When I go to get loans or mortgages, I actually just show them my life insurance statement and they go, cool, check. But what's awesome is if I get sued, they can't touch this money. I can literally have millions of dollars stored here and they can never get to it. They can get to my savings accounts, they get to my IRAs or anything else, but they cannot get to my life insurance. If I get sued or creditors are after me, they can't touch that money. Even if with my kids, I have 8 kids, right? They're almost all teenagers right now. For college funding, this does not count as an asset. So isn't that cool that it counts as an asset when I want it to, like when I'm trying to get a loan, but it does not count as an asset when I don't want it to, like when I'm trying to get, like funding or scholarships, or if I'm trying to, if somebody's trying to sue me, that money's off the table. So it's such a great Swiss Army knife to have in your.
It really is. And a lot of people they can't fathom a tool that could generate money that's not in the banking system. Like, wait, it's insurance? It's like, yeah, there's like literally nothing else like this. This is the only type of investing outside of the banking system that there is, unless you talk cryptocurrencies, and that's a whole nother basket. When you're talking about insurance, there's literally this. And it's extremely.
It's literally been around for hundreds of years.
The craziest thing is how many of the wealthiest people in the world use exactly these policies. So we know that there's a lot to it.
Exactly.
So Chris, what's the top financial thing that they could start with, like right away to get going?
It depends on where you are right now, but I would go through this 3-step process: is get lean, get liquid, get out. Right. So get lean means make sure you're actually monitoring and watching your cash flow. I tell people, whether it's business or personal, really it should be both. If you're a business owner as well, is make sure you're monitoring your cash flow, like how much expenses are coming in, how much is going out. Track your money. If you're using QuickBooks or whatever you're using to track that, whatever you're using for personal side, if you're using Monarch or Rocket Money or something like that, track your money on a weekly basis. Know exactly what's happening with your money, because money leaks happen when you're not watching. It's like anything, right? It's that law of attention. Whatever you put your attention towards will expand and grow. But whatever you ignore will decay and leave you. For example, if I stop brushing my teeth because I ignore my teeth, they'll leave me, right? If I ignore my spouse, she'll leave me. If I ignore my kids, well, they'll probably leave or die,
They'll ask for
something
more.
like that, Yeah, exactly. Yeah. With 8 kids, I could leave. I could easily forget some, but those kind of things, right? Like, so you want to make sure you're paying attention to it. So tracking it, you'll find money naturally that way. Get liquid means make sure your money is liquid. We just talked about a big strategy like with infinite banking is a great way to get liquid. Most people are taught by financial advisors to lock your money in prison, pay down that mortgage, right? Put it in equity. Well, I learned firsthand the recession when I pay down my mortgage. Well, that doesn't mean anything if I can't turn around and sell it later on. Because even if I had equity, I watched the equity disappear because the credit market shrunk, right? And so I was stuck with the property. And then Lehman Brothers owned the notes. So they wouldn't even let me short sell the property. And I eventually had to foreclose on that property. I lost all my equity. I would have been better having that money in cash liquid. That would have helped me weather the recession better than trying to pay extra on my mortgage or fund into a 401k that you really can't get to when you need it, right? Like, don't do that stuff. Don't lock away in prison. Get it liquid. And that's where infinite bank is a great strategy. And then get that money out. Get it out to investments that create passive income right now, and start creating multiple streams of income coming in. So you're not just relying on that one mainstream of your income. That's the active income, whether you're a business owner or whatever it might be. Don't rely on that one stream. That is gambling. Get multiple streams of income. So even if that one stream gets reduced or even sacrificed, you're okay. That you're always going to be set. That's the key advice I would give you.
So then beyond Money Ripples, are there any like resources or books or even tools, like apps are big nowadays, that you would recommend to people?
We do have the Work Optional Blueprint book that's coming out, that's releasing right now. And that book actually talks a lot about those strategies and different things you can invest in and things like that. And so we're trying to, I hate writing. This is why I do podcasts, but I finally had enough clients and people saying, can we get it in writing so we can actually like read it and consume it? And so we finally did. We finally put it into a book. This is like decades in the making of what I've learned over the last several years of what's helped me and others become work.
And what was the name of it?
Passive income quit. It's called Work Optional
Blueprint. And you can get it on Amazon?
Yep. You can get it on Amazon or just through our website, moneyripples.com.
Awesome. So Chris, how can our listeners connect directly with you?
You have moneyripples.com. We have great ways you can book calls there. You can also follow our Money Ripples podcast that we've now had for 11 and a half years. You can follow that as well. We're about to hit episode 1000 here pretty quick. And then of course, anything at Money Ripples on social media.
Well, thank you so much for coming and doing this with us today, Chris. I really appreciate it. I think a lot of our viewers are going to get tremendous value from it. And I hope that people take you up on your offer and they start to experience the benefits that I've experienced of this type of whole life insurance, plus all of the other things that your team has to offer to help boost cash flow, save money, and make people stable.
Yeah, I appreciate that, Ari.
Absolutely. Well, you have a good one, and we will talk to everyone on the next podcast soon.